Imagine holding $277 billion in cash. That's the kind of money Warren Buffett, the Oracle of Omaha, has been quietly sitting on. Warren Buffett, the legendary investor and CEO of Berkshire Hathaway, has always been seen as a leading indicator of market sentiment. When Buffett makes significant financial moves, the world pays attention. Recently, Buffett's actions have sparked concerns that a potential market downturn could be on the horizon. Over the past few months, Buffett has been quietly shifting his portfolio, which now includes massive sales of Bank of America and Apple stock, alongside building up a historic cash reserve of $277 billion. So why would Buffett, known for his long-term investment approach, start selling significant portions of his portfolio? Could it be a sign of an impending bear market, or is Buffett simply repositioning in response to volatile economic conditions? Financial experts are now debating whether Buffett's strategic moves are a signal for investors to brace for tough times ahead. While we can't predict the future, history shows that Buffett's moves often precede major shifts in the market. In particular, we'll explore his decisions surrounding Bank of America and Apple, two pillars of his portfolio, and how they might reveal his concerns about the broader economy. Moreover, we'll analyze the $277 billion cash stockpile Berkshire Hathaway has accumulated, a move that echoes his strategy from the 2008 financial crisis. By piecing together the data, we can gain a clearer picture of what Buffett's recent moves might signal for the future of the stock market. In today's video, we look into Buffett's recent moves and what they could mean for your investments. You won't believe what we uncovered. What the market means as Berkshire Hathaway's cash pile tops $277 billion. One of the most eye-catching developments in Warren Buffett's recent strategy is Berkshire Hathaway's massive cash pile. As of Q2 2024, Berkshire Hathaway held a record $277 billion in cash, its largest capital reserve ever in the company's history. This is not the first time Buffett has chosen to hold a significant amount of cash, but the sheer size of this reserve is causing market analysts to wonder if Buffett is preparing for a major market correction or downturn. Historically, Buffett prefers to hold cash when he believes the market is overvalued or when attractive investment opportunities are scarce. By holding onto cash, Buffett ensures that Berkshire Hathaway is well positioned to take advantage of future opportunities, particularly when asset prices decline in a bear market. In 2008, during the height of the financial crisis, Buffett was able to make lucrative deals by investing in companies like Goldman Sachs and General Electric at discounted prices. Could a similar strategy be in play now? This cash stockpile also gives Berkshire Hathaway a tremendous amount of flexibility. In the event of a market correction, Buffett could deploy billions to acquire distressed assets, as he has done in previous downturns. This strategy contrasts with other investors who remain heavily invested, even during periods of uncertainty. By holding cash, Buffett is signaling that he sees fewer appealing opportunities in today's market, which may suggest that stocks are overvalued or that economic conditions could worsen. Additionally, Berkshire Hathaway has recently increased its investments in U.S. Treasury bills, which are considered one of the safest investments during uncertain times. This move further emphasizes Buffett's cautious stance, prioritizing liquidity and safety over higher returns. While it's impossible to know exactly what Buffett's next move will be, his cautious approach suggests that he's preparing for significant market volatility in the near future. Bank of America Holdings. Buffett's $7.2 billion sell-off. Warren Buffett's relationship with Bank of America has long been one of mutual admiration and strategic investments. Buffett first acquired Bank of America stock in 2011, and since then, the position has grown to be one of Berkshire Hathaway's most significant holdings. As of mid-2024, Berkshire Hathaway owned approximately $38 billion worth of Bank of America stock. However, what's caught the market's attention recently is the sale of $7.2 billion worth of Bank of America shares in just a few months. Buffett has praised Bank of America's CEO, Brian Moynihan, and expressed confidence in the bank's long-term prospects. So why the sudden decision to sell a substantial portion of this holding? One explanation could be tied to the broader financial sector, which has been facing challenges due to rising interest rates, stricter regulations, and economic uncertainty. Bank stocks tend to be sensitive to economic cycles, and with growing concerns about a potential recession, it's possible that Buffett is reducing exposure to the banking sector as a precaution. Moreover, Buffett's decision to sell Bank of America shares follows a trend where he has been reducing his exposure to the financial sector overall. Earlier in 2024, Berkshire Hathaway also sold portions of its holdings in Wells Fargo and U.S. Bancorp, further indicating that Buffett is reevaluating his positions in this industry. By selling off part of his Bank of America stake, Buffett could be signaling that he expects the banking sector to face headwinds shortly, potentially driven by rising interest rates and tightening financial conditions. On the other hand, it's important to note that Buffett still retains a substantial position in in Bank of America. This suggests that while he may be cautious about the short-term outlook for the banking sector, he still believes in the long-term value of the company. The question remains, does this sale indicate a shift in Buffett's overall strategy, or is it a move to mitigate risk in an uncertain economic environment? Buffett's relationship with Apple and recent sales. Perhaps more surprising than the Bank of America sell-off is Buffett's decision to trim his long-held Apple position. Apple has been Berkshire Hathaway's largest stock holding since 2016, and for years, Buffett has praised the company and its innovative technology. In fact, at the end of 2023, Berkshire's stake in Apple was valued at $174.3 billion. However, in the first half of 2024, Buffett sold more than 389 million Apple shares, over 5% of Berkshire's holdings in the company. Despite this massive sale, Apple remains Berkshire's largest holding, with 400 million shares left, valued at $84.2 billion as of the end of Q2 2024. Why sell such a profitable stock? Market analysts suggest that Buffett may have been cautious about the tech-heavy stock market boom driven by artificial intelligence and automation. Buffett seems to follow his old rule: be fearful when others are greedy. One factor driving this decision could be the company's valuation. When Berkshire Hathaway first invested in Apple, the stock was trading at less than 15 times its projected earnings. Fast forward to 2024, and Apple's stock is now trading at around 30 times its projected earnings for the fiscal year ending in September 2025, according to reports from Barron's. This significant increase in stock price may have led Buffett to view Apple as overvalued, especially considering its slowed growth trajectory. Another consideration is Apple's legal and regulatory hurdles for alleged antitrust violations related to its iPhone and App Store policies. While Apple has vowed to defend itself vigorously, analysts have warned that the lawsuit could create headline risk and weigh on the company's stock for the next 2 to 3 years. This legal uncertainty could be a factor in Buffett's decision to reduce exposure to the stock. Moreover, Apple's ambitious plans for future growth appear to be stalling. After spending a decade and an estimated $10 billion on its autonomous electric vehicle project, Apple recently announced that it was abandoning the initiative. The EV project had been viewed as a potential new growth engine for Apple, but its cancellation leaves the company without a clear path for future innovation beyond incremental updates to its existing product lines. Investment bank Needham echoed these concerns, calling Apple's near-term growth outlook anemic to negative. The possibility of further sell-offs from Buffett cannot be ruled out. Edward Jones analyst Jim Shanahan told Bloomberg that while it was once unthinkable for Buffett to sell all of his Apple shares, the current environment makes such a scenario seem less far-fetched. Shanahan went as far as to say, "I don't think zero's out of the question now," reflecting a growing sense of uncertainty about Apple's future in Buffett's portfolio. Ultimately, Buffett's 55.8% sell-off of Apple shares is a major signal to the market. Whether motivated by valuation concerns, legal risks, or doubts about the company's ability to innovate, the move has cast a shadow over Apple's outlook in the eyes of one of the most respected investors in the world. For now, all eyes are on Buffett to see if more Apple shares will be sold in the coming months, and what this may mean for both the stock and the company's future. Is this an alarming situation? Buffett's recent actions raise an important question. Is the Oracle of Omaha signaling a market downturn? Historically, when Buffett piles up cash instead of investing, it's a sign that he believes the market is overvalued or that a significant buying opportunity might soon present itself. This strategy aligns with his famous saying, "The first rule of investment is don't lose, and the second rule is don't forget the first rule." Yet it's important to note that Buffett isn't necessarily bearish on the US economy in the long term. He has consistently expressed confidence in the resilience of the US stock market, but he's unwilling to overpay for even the best companies. His decision to amass a cash reserve is a move to preserve liquidity and stay patient until market valuations become more reasonable. So, should investors be concerned about this situation? While Buffett's actions should give us pause, they don't necessarily mean a crash is imminent. He's simply waiting for the right opportunity to buy at a fair price. If anything, this could serve as a reminder for individual investors to stay cautious, avoid overpaying for stocks, and keep cash on hand to take advantage of future opportunities. So, what should investors do? To wrap it up, Warren Buffett's massive cash pile, along with the significant sales of Bank of America and Apple shares, may be his way of preparing for a potential market correction. His actions suggest he's finding fewer attractive opportunities in today's market, which is largely driven by tech stocks and speculation around AI. However, this doesn't mean investors should panic. Instead, take a leaf out of Buffett's book. Be patient, cautious, and always prepared to act when the right opportunity presents itself. As Buffett himself once said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Will you be ready when the rain starts falling? Let us know your thoughts in the comments and make sure to subscribe to our channel for more amazing content.